Hi, this is Peter Hans, and welcome to this week's episode of Between Two Chains. I'm recording this on January 13th, and the guest today is Michelle Noyes, Managing Director of AIMA and Head of Americas, the Alternative Investment Management Association, the acronym for those who don't know it. I've known Michelle for a long time. She's super smart. She comes from a emerging markets and hedge fund background prior to AIMA, where she's been for the last 10 years and started it in the US. It's headquartered in London. We have a great conversation about how the digital assets market and events have really changed the timeline for institutional investment and even adoption, and what that might look like now for legacy, large traditional finance players. We talk about the need for operational due diligence and maturation in the industry. And of course, we still talk about what we think is a very promising future where the interest really has not dissipated, but perhaps changed a little bit. So I hope you enjoyed the episode. Please rate and review. Thank you very much.
This commentary is not intended to be investment advice, investment research, or recommendation. Please consult your investment professional for your own circumstances.
Hi, everyone. This is Peter Hans, and welcome to this week's episode of Between Two Chains. I'm really excited today because we are joined by Michelle Noyes, Managing Director and Head of Americas for AIMA, the Alternative Investment Management Association. Michelle, how are you?
Good. Don't have any chains next to me, but thrilled to be here on the podcast and have a conversation with you.
Absolutely, absolutely, and much of the audience, this being from a more traditional finance lens, even though we're focused on blockchain technology and digital assets, going to be, very familiar with AIMA and probably even a lot of AIMA's efforts into digital assets, and we've talked for a number of reasons in the past, but one of them has always been around the AIMA's efforts in the digital assets working group. And I would love to hear a little bit more and maybe share with the audience a little bit more. I think two things, just kind of, where your personal interest, because obviously you have an emerging markets background, hedge fund background as well, worked in Brazil, which is obviously very pertinent to kind of the overall mantra of the space. But you personally, and then also AIMA, which I was, very, very pleasantly surprised to see their involvement, a couple of years ago and continued involvement. So, what the approach there is.
Sure. So happy to start it off, I guess, with myself. As you noted, I have a penchant for emerging markets. I started my hedge fund career in Sao Paulo, Brazil, of all places, working for a local asset management with hedge funds, as well as structured and private credit and infrastructure private equity. And, living there, you can see the great potential of these markets. And it was my job really to engage with all of our non-Brazilian clients to tell them the story of Brazil, to bridge that educational gap, to get them to come to country, have the conversation, see their eyes light up when they recognize the breadth of local talent, not just my colleagues, but there's a whole ecosystem down there that was really interesting. But then also just as an expat, I think you never feel the volatility of a currency until you live between them. So, my early days in Brazil, I moved down there, I think at the end of 2009. And shortly thereafter, the real hit its strength at, something close to 1.5. And everything felt expensive. And, all of the Americans coming in would talk about the currency. I know my sister and some of my friends came in for Carnival one year, and we went out to dinner, and like a pad thai was $70 or something crazy. And then we started using pad thai as a measurement of currency when we were talking about how expensive something was. By the time I left in 2012, that had gone down somewhere between 2 and 2.5. And I remember being really, sad when I was withdrawing my reals back to dollars. I've taken this loss, but thank goodness I did, because, fast forward and it's, touched somewhere between, I think 5.5. I haven't looked very, very recently, but, I was back down there in 2019, and again, everything felt cheap. It was a bargain to stay at the hotels I once frequented, or even the taxi from the airport into the city. So I think, when you're in an environment like that, you do recognize, both the inherent instability and volatility of currency. So maybe you are less, you're more tranquil about the volatility of some digital assets and digital asset currencies. You also, they have a legacy of hyperinflation. So the Bitcoin story makes a lot of sense. And, to be clear, this was my Brazil days were before my crypto days, but I think it sort of primes you. And then just from a professional experience, I love being that storyteller, and it's really awesome to be able to see people be able to make that connection. And there's some other similar strategies and stories, but it's digital assets in many ways is an emerging economy, is an emerging market. Mm-hmm. And I think that's been a really interesting transition in terms of my career, while still doing the traditional finance side of alternative investments, which AIMA is known for, namely in hedge funds and private credit. So happy to talk a little bit about AIMA's journey into digital assets as well. I mean,
absolutely.
When I left Brazil in 2012, I ended up joining AIMA and opening up their US office for the first time. AIMA, as of this year, now that we've crossed the calendar, we are 33 years young, so have a long and established history. Very global, headquartered in London. We've been in Asia since 1998, and I had been a volunteer for the association because I'm one of those people who just can't help myself convening people. Again, I think this is why crypto is so appealing as well, just this community aspect of the whole thing. So, as a member of AIMA, as a volunteer down in Brazil, and then when I was moving back to the US, stepped into a role to open their US office, and that's continued to grow. And AIMA, we have our roots in hedge funds, and there's a lot of similar parallels to the digital asset story when you look at hedge funds. When we started, it was a small community, largely unregulated. A lot of it was just about education and explaining what these things called hedge funds were, especially as institutions were taking their baby steps into the space. We then went through the great financial crisis, and there was a real change in regulation. We had both AIFMD in Europe and Dodd-Frank in the US. And there was a need for the industry to really come together and have a more structured approach to government affairs and explain to regulators what we do, the value of what we do, and how we can continue to be, a productive force in the capital markets. So that was something that really shifted our focus and, saw the association grow and professionalize as a result alongside all of our members. And as that's continued along the way, it's, hedge funds it's always been hard to definitionally categorize a hedge fund, right? They're called an asset class. It doesn't really fit that definition quite well. Some people could say they're united by a fee structure, but even that falls apart as a definitional structure these days. But it's really unconstrained active management. It's investment professionals who have a point of view and want all of the tools in the toolbox to be able to express that, whether it is going short, whether it is using leverage, whether it's using derivatives, options, all sorts of different markets. So that creativity has continued to expand our mandate to a degree. So, coming out of the post-financial crisis era, we saw a lot more hedge funds get involved in direct lending. That led to the opening of Alternative Credit Council, which has continued to grow as that space in private credit continues to grow. And then, fast forward to sort of end of 2017, I think is when members started getting more involved in digital assets. And at that time, it was more people quitting their hedge fund jobs, deciding they wanted to start trading these digital currencies and having to create a new boutique. Because, at that point, the legacy investment managers weren't doing it. And, we were always a venue for education. So I think our very first panel was February 2018, I want to say. In that year, we started pulling together a working group at that time called DAB, the Digital Assets and Blockchain Group. We did panels around the world. We, hosted a session at our flagship investor conference. And, it was more about talking shop and really in that education phase, similar to the very early stages of what AIMA was doing in hedge funds. It went quiet during that crypto winter. I have to get used to saying that crypto winter versus crypto winter writ large. But, it's still, we would have conversations every once in a while. And then in 2020, I think what was really a watershed moment is when Paul Tudor Jones announced, not only am I investing in digital assets, because we had seen a few principals of big financial firms dabble personally in their family offices, but, my investment management firm is starting to invest. And suddenly it took it to, our primary constituency at AIMA, which are legacy hedge funds, the biggest global macro, multi-strat, quantitative hedge funds in the world. This was becoming part of their business. And as such, we were able to prioritize it within our workflow, because as an association, you always need to make sure you're prioritizing managing resources appropriately, not going down rabbit holes is great for your own education, but as an association, you want to make sure that you are following member interests. So we reinvigorated our work, got together with John D'Agostino, who, when we were running DAB, he had the much cooler acronym DOG, but there was a lot of cross-pollinations between the group, and basically invited him to bring DOG within AIMA. So we rechristened the effort AIMA DOG. I think officially relaunched under that name in January of 21. And it was, we got all of the traditional investment management world, along with the investment boutiques focused on digital assets, together, and said, okay, again, within AIMA's work, we do government affairs, we do education, we do sound practices and things like DDQs. We do research, help us prioritize what's going to be most impactful at this stage. We know everyone is busy, including ourselves, but we want to make sure that we can actually get things done versus nobody needs us. Nobody needs just another meeting to go to. We want to make sure that this is actually productive. And it really took off from there.
Yeah, there are a lot of avenues we can go down, but I think one thing I want to circle back up on is the Paul Tudor Jones moment, because I think that is a important one to talk about, because especially one of the things that you were talking about at the beginning about emerging markets and currency and kind of the Bitcoin narrative. Obviously, Paul Tudor Jones, macro focused, was really about Bitcoin, and if I recall, the argument or the paper, the letter he put out was basically it had more to do with the price expectations versus ranking interest, meaning that there was a discrepancy in terms of how people thought it would perform, at least internally in the survey he took, versus the interest in the allocation to the asset. And it was obviously very good timing, and I'm sure he did quite well. That said, I think we're in a interesting time in the market, and we talked about this a little bit the other day, and I talked about this on the first podcast of the year, or in our 2023 predictions, where I am personally expecting and almost hoping for a going back to the narrative, even though I don't necessarily agree with the exact verbiage of blockchain, not Bitcoin, but I think there needs to be a big separation between the different elements of digital assets. And I really liked your emerging markets description, because yes, in any emerging market, there is typically a non-dollar pegged native currency that like the real, but then there is also infrastructure and growing economies and playing GDP and different startups, right? Just like you see with digital assets in terms of infrastructure and new businesses and opportunities that can be built leveraging blockchain. So, one thing I'm interested in is when you guys, I guess, relaunched DOG, Digital Assets Working Group, back in 2020 and 2021, and saw kind of the growth and the hype that built up throughout that market. how much do you think there was kind of differentiation amongst new entrants, who are in more traditional finance, more traditional hedge funds, or even allocators between, digital currencies and infrastructure and Web3 private companies, because I never saw like a lot of differentiation between venture and liquid token investing, even though in my mind they're quite different. And then how has that potentially changed of late, and what do you expect going forward? So sorry, there's a lot there, but you have a very unique perspective here.
Yeah, let's see if I can unpack that. I mean, I think that, it's worth noting that, again, I mentioned AIMA has a hedge fund background. So we're probably more biased versus the industry on more trading oriented strategies, although digital assets has brought the convergence between hedge funds and venture closer than it's ever been. You can argue it had been happening on the TradFi side with some long short equity hedge funds starting to make private investments. So it's not that it was absent completely in traditional finance. It's just in digital assets, the crossover was a lot more fluid. So we would have, hedge funds who would also be making more venture style investments, either through tokens or more illiquid. And then also venture funds that would get distributions in tokens and suddenly find themselves managing a more liquid sleeve than they would normally be accustomed to. So as a result, we have brought into the church, into the fold, some more venture type funds than we would normally see in the majority of our work, which has been really, really interesting. There's always going to be more trading oriented strategies and folks who are bringing liquidity and efficiencies to the market, and that has value, as well as more long-term oriented investors who are betting more on directional growth. And I think both have their functions, both have their return profiles being different. Again, another sort of Brazil analogy that comes up, we had, the firm I worked for had a brilliant market neutral hedge fund. Local investors loved it. It was stable, great source of alpha. But, I talked to international investors and they're like, we're not in it for the alpha. We want the directionality. We want the beta. And I think that comes out when you're looking for an investor. If an investor already has a substantial allocation to digital assets, they might see the value in adding something a little bit more market neutral, although that term, like many terms, have often been infused in digital assets as they've been co-opted from traditional finance. But it's harder for someone who's making their first investment in digital assets. A lot of times it is more of that thematic play on a long-term growth of the technology, the disruptive power of that technology. I suspect in some ways, as we see further convergence, you might end up in a space where, again, more of a multi-strat hedge fund could do some of that arbitrage trading within a diversified portfolio. Right? It's another alpha engine. And then therefore the underlying LP isn't necessarily making that specific bet. So they'll be benefiting from it at one point or another. Whereas their dedicated allocations will look more like venture, whether they are truly illiquid or they might be more liquid in nature. So I think, you see both of those. I do think, at the risk of jumping ahead with all of what's transpired in 2022, there is a real desire to go back to basics, right? And say, what are we doing? Our thesis that, again, this is a transformative piece of technology, many cases, not all, but many cases still holds. And investors, especially investors and LPs are looking for, how can I get exposure to that without the speculative magic internet beans, right? How can I see like true cash flow generation? I want to, make sure I really understand how this works. And that's going to be, I think, a driving area of inquiry for 2023. And we can talk about the different ways that plays out. So I think it's a long way of saying I agree largely.
Yeah, no, and I think there's so many reasons why, these dynamics exist, from the fact that, this has been largely at least to start, a kind of retail driven market, grassroots almost, right? It had to have been. And then, like anything else, when there's money to be made, money comes in and institutions have the money and the, funds that existed. Because you're right. When I would talk to institutional allocators about exposure, and there was always, you could buy Bitcoin or ETH directly, right? There were larger venture funds, and whether it's the A16Zs and the Bains of the world, or more, crypto native, like your paradigms, right? But they would have everything in the bucket of their venture books predominantly, if they had it in a bucket at all. And when I would ask about liquid opportunities, that they were in the venture portfolio. So it was really just a structural issue of, this is structured like a closed-end 10-year fund, but half the funds in liquid investments, right? Where then you could also have hedge funds with 3-year lockups that invest illiquid, and you don't really see the traditional special sit fund, long short like you would. And granted, there are a lot of reasons for that as well, mainly being the counterparties are different. There aren't prime brokerage. It's very difficult to short. There's not a lot of data for optimizing a portfolio, for balancing your VAR and your betas, and if you think you have a certain VAR, like, it could turn out to be totally wrong. So there's a lot that's going on here, and I think people like analogies, and they like parallels to past examples and environments that they can look to for a blueprint, and I don't want to say guilty of it, because I don't think it's wrong, but I've always looked at it, any other emerging technology, and the internet is a good example, where you always had non-believers, even, from the 80s up until the, early 2000s of can you actually make money off this? Is there actually something do here? And I think there's a lot of parallel to blockchain overall, but the difference being that blockchain has created digital assets, which are liquid instruments that can be traded and sold peer to peer, which you just didn't have in the internet days, right? The early adoption of the internet days. So it's definitely a wrinkle that's really difficult to wrap your head around, especially if you're a regulator, and the market moves so fast and is so global that it just presents a lot of challenges for any market participant or regulator. So, like, take a step back, I guess, how do you guys at AIMA, like, even think about that?
Yeah, no, I mean, it's interesting because I do think, you've gotten financialization on hyperspeed as a result,
yeah,
of this. And, again, I think that this reset is a good opportunity to, really question those beliefs and see how you can build incentives and, invest in an aligned fashion. Because even, if you look at NFT projects and DAOs and things like that, again, as an association professional by training, it's sort of interesting because you end up in these funny places where, if I sold membership tokens, I don't want a bunch of speculators inside the membership who are just joining and buying the tokens to make it go higher. I want people who are actually contributing year on year and actively engaging, and it totally distorts the functioning of a healthy community sometimes. And, there's lots of people working on those problems. And I think, we've seen digital assets recreate a lot of the challenges of traditional finance on a condensed time frame. I mean, I think it's nice in theory to think that everyone can just learn the lessons before them and not have to go through that pain, but probably impractical. Just like you said, our brains are naturally wired to think in stories. It's just probably something embedded in the human condition, but it's gone through these crises, and it'll be painful. There's, massive losses of trust as well as capital. So, I think it's foolhardy to just say, well, that's what it is. We'll emerge stronger. I do think we will emerge stronger, but, also can't disrespect the pain that it's caused along the way.
Yeah, absolutely. And, there's a few things that don't help. I think one, there's a lot of infighting and different opinions within the digital assets ecosystem. And, I don't have to get into the specific, anyone can just go on Twitter and figure that part out. But the nature of, and I think you bring up a great point about the membership token. Blockchain ultimately is a technology. And that's why I think it's, I welcome, and I think it's very healthy. And I wouldn't say blockchain, not Bitcoin. I would say, blockchain and Bitcoin, or, because they're one can think Bitcoin is viable or not viable. And, I personally look at more of a call option, a potentially very valuable call option, but it's a call option. But, blockchain itself is a technology, and a ledger can be, and I have used it, IRL, right, for a number of things. But not everything I do is under the, expectation that it's, that it's some like pump and it's going to be up 30x and I'm going to flip it. Like, it's just, and NFTs are a great example of that. Like and I talked to Raul Pal about this and in an episode earlier where we were both on the same page of the NFT is the most, in my mind, kind of misunderstood technology aspect of blockchain, because really what it represents is a contract, a source of ownership, and something that's like immediately transferable anywhere and immutable, right? So think about all these legacy lines of way we do business, from title insurance to closing on homes to car loan. Like, all of this stuff can be represented in the form of NFTs that signify ownership in real life goods and services. So, and granted, not every thing is an investable asset. Just like in real life art, like if I own, I own art technically over my shoulder, right? A photograph by Paul Nicklin, who's an incredibly talented National Geographic photographer, and that is, this stuff is like serial numbered, and it's not something I could go buy at, Michael's, but that's not an investment for me. I bought it because I like it, and I'm not, and I'm not going to sell it. Just like if I buy I'm not a big JPEG collector, but if I bought an NFT, it wouldn't be under the guise that, I'm going to flip this and make a bunch of, money. And I think getting away from that mentality is ultimately going to be very healthy.
Yeah, no, it's definitely, it's been interesting because I've, used the NFT markets as a great way to learn the ropes of digital assets myself. Because, it's just, you feel these things at a different level when you're actually, again, transferring assets between wallets, breaking out in the cold sweat, as you see different scams abound. And it is, it's a consumable. Yes, it's a consumable that, can appreciate in value, just like selling something on eBay can, and it's much more efficient. But, I think that was really underscored once you started seeing some VCs come in and, they weren't buying the tokens, they were buying equity in the parent entity. It's like, okay, you all thought you were VCs, but here, it's different. It's valuable. It's a great building block of what can come. And I think, we've seen a lot of big brands entering the space, again, from a non-financial point of view, which is going to be very, very interesting. In terms of these different points of view, they're definitely there. And, our members invest in very different ways when it comes to digital assets. But I think there's a commonality of purpose when it's, how can we come together and help this space institutionalize, recognizing the irony that it all evolved to disintermediate the institutions in the first place. Be that as it may, we want to make sure that, we understand what it means to manage other people's money. We understand that the fiduciary responsibility. We understand all of the various risk points, be that counterparty risk, cybersecurity risk, what have you. And, in absence of clear regulatory guidance, which, probably won't come in the short term at this point, you're still operating a business, your peers are still operating businesses, and you want to do so as robustly as possible. And there's a lot of common ground there between peers of digital native peers and traditional finance peers, but everybody working together on, how can we get to that point where we can build confidence so that we can invest, we can build confidence so that LPs entrust us with their investments, and ultimately so that we can focus on what we really want to be, which is security selection and actually investing. But,
Yep.
there's so much other stuff that goes into it because, again, at the end of the day, maybe we'll eventually get to a point where, you don't need a separate working group. We don't have a AIMA commodities working group or an FX
Sure.
working group or an equities working group, right? It's just digital assets. If you invest even a tiny amount of money, it just brings a world of operational uncertainty, compliance uncertainty, and pain, which is why, we felt the need that it's important to convene particular groups to look at these things and, again, find where there are gaps that are not addressed by, just the traditional output that we have, find what needs to be crypto specific. So, over the past 2 years, we've put out research on adoption of digital assets by traditional hedge funds, which we can talk about. We did a guide to custody because that was really, the main
That's
primary.
a big one.
That was the main sort of obstacle. And it's always, okay, great. Feel like we've gotten some great solutions. And then the investment strategies get ever more complex. So the custody strategies have to get more complex. So it's not static, but there's been a lot of progress in that space. We're, putting the finishing touches on a due diligence questionnaire, which is something I've personally been working on for the past, 9 months at this point. I thought it was hard when I used to have to fill out DDQs as an investment manager because I've been there on the other side of the AIMA DDQ. It's definitely a lot of work to curate those questions and make sure you're getting to the heart of the issues, working on a trading guide. So, all of these areas are areas of synergy where peers can come together and say, okay, let's get some solutions. So then, again, we can get back to making the best investments.
Yeah, the DDQ is a beast in this space because every due diligence call brings about questions that you either didn't think of or wouldn't have thought of to put into a digital asset specific DDQ. And, in my conversations over the past, 18 months, I would say, and obviously the more sophisticated, larger investors, consultants are gonna harp on operational due diligence, more so than investment due diligence, right? But the custody question was just a tough one, right? Because everyone is so used to who's your prime broker, who are your custodians, let me go talk to them. And here it's like, well, they don't custody this asset, or we work with Fidelity, but they only custody Bitcoin and ETH, so we have to do this, and then we have these wallets. It's just, there was such a learning curve there, and is that in your mind? Is that kind of one of the biggest obstacles that you guys have seen talking to investors?
Yeah, I think again, it's when you're at this phase in the market, when you're getting the sort of traditional institutional investors, and it's one thing, right? If you have your friends and family who generally trust you not to abscond with their cash, right? Recognize that there's volatility in the market, they'll kick the tires. But when you have people who have a fiduciary responsibility, and ultimately where there's, again, they're a gatekeeper, right? It's other people's money, whether that's on behalf of one patriarch or, a whole set of pensioners who, are counting on these returns to, retire in what they were promised. There is this level of diligence that's appropriate, and you have to layer in, well, on the one hand, I'm not going to lower my standards of what I would be asking any other hedge fund or venture capital fund in traditional finance. I can change my questions, right? I'm not going to torture you with questions about prime brokerage if there's not a prime broker in this chain. But then I also need to know what to ask that's digital asset specific. And I think there's a learning curve on both sides, right? You did see a lot of digital asset boutiques come into this market, not necessarily from finance, but from technology. And they just may not know what the expectation is in terms of what answers should I prepare, what questions are going to be asked, what level of transparency is appropriate and necessary in this space. And, it's in different parts of the market, right? If you have an in-demand fund, maybe you can dictate terms a little bit more, but in this market, I think you should be very prepared. And also, right, it's painful. I've been there. I was in that seat. It is not a fun thing to go through, but all parties are better off when you get through all of that in advance and there's no surprises.
Yeah.
Down the road.
It's a small, I mean, it is the nature of how, to your point, right, fiduciary asset allocation works, right? There are a lot of boxes to check, especially as you get into the pension world, the endowment world, right? And, actually, I had a funny story and this was pre, everything really crashing last year, but I talked to a very, very large, maybe the second largest U.S. pension. And, they had an effort in the space and said that they, were talking to a big name in the kind of digital assets and crypto investment world. And we're going to move to ODD stage. And, their normal process is, however many hours on the phone. And they were like, we'll give you 90 minutes. And they were like, well, no, that's not the way it works. We have to set up these calls and this is how long it takes. And they're like, well, you can't have that. We'll give you 90 minutes. And they closed their fund and all that stuff to them. But and obviously this pension didn't invest, but, you look out like more than fund whatever it was, into the future. Like, do you really care about building a business or is it just that naive? And I think looking back now, I mean, it's certainly, and I don't know if the manager regrets it or not, but it doesn't help from a trust or maturity standpoint. And even if it's just optics, it doesn't help. And I would imagine there's a lot of trust that's been lost over the past 6 to 9 months.
I think so. I mean, there's a couple of points in there that are important. I mean, first is whether you want to run an institutional business. Not everybody does, and that's fine because, again, there's a tremendous obligation if you do so. Usually there's a lot more pressure on fees. There's a lot more reporting obligations. There's a lot more transparency. And, if you want to build a business at scale, you're probably going to do that, but that takes you away from investing. So if you are a PM that just loves being in the markets and you have enough money from friends and family and well-aligned investors who generally leave you alone, you might have a good life just doing that. And that holds true whether we're talking digital assets or any type of investment strategy. But I think that's a real question that PMs have to ask themselves strategically before they go down this path. And then, we talked about educating the investment managers on what sorts of transparency is typical to provide and the value that a DDQ can provide in that. And, it's just also the thing that used to drive me crazy is I'd get all these, RFP requests and, one would ask you how many years has so-and-so been doing this? The other would ask you in what year did they start? The same piece of information, but I can't copy and paste it, right? Because they asked it in different ways. So the idea is, you fill out this beast hopefully once, and then, that can be the starting point of follow-on questions because it's never going to capture 100% of everything for every specific strategy or investor. But the second part of it is also educating the institutional investors and gatekeepers on the crypto specific risks. It's not to say some of them have very sophisticated individuals within their organizations, mostly because they have a crypto hobby at nights and weekends and have been following this markets really closely and, have a really good read on it. So some of them are, are light years ahead, but a lot of them, it's really, there's a lot of different risks involved, some of the same risks, but, you do have to understand custody. You do have to understand wallets and how they work. You do have to understand what's involved, potentially if a manager is going to be staking, lending, a whole host of different things, participating in a DAO. So, the way that this DDQ is set up and structured is, you'll have, a lot of the beginning parts common for any investment strategy about the governance and the operations of the firm. And then there's a lot of skip logic. Okay, are you doing this? If yes, here's a couple questions. If not, skip. Doing this? If yes, skip. And it'll be probably updated more frequently than our other DDQs just because the space is changing so quickly. So
absolutely.
It's an innovative market, and everyone likes to push boundaries. So, if there's a new strategy that takes hold and needs further points of focus, that can get updated.
Yeah, DDQs in this space are stale as soon as you save them, even if it's just the AUM and things like that, just because of how much it fluctuates. But yeah, that's is the DDQ you have been working on, is that designed for managers to use as a template? Is it designed for allocators to use as their template, or kind of both?
Both. So an investment manager, provided they are a member of AIMA, could use that as their basic DDQ and then proactively provide that to any allocator that's getting to the due diligence process. So typically, awesome. Right, it's something, in a second stage once there's been a gating conversation, because nothing in there should necessitate an NDA. That's basically the thing. But, you may not want to share all of that gory detail on your very first date. So you sort of ascertain interest, and this is the next step. Or an allocator who's a member of AIMA could proactively send that to any investment manager that they are diligencing. And it's, again, all members don't have to use that if they have a very well-established DDQ that they've been using for years and have good success with. There's no obligation. It's just, here's a healthy starting point. And again, if we can all just basically agree that 80% of what we want to tell you and what you want to hear is largely the same, let's just agree to ask it in the same format so we're not wasting anybody's time, because presumably they want you and your colleagues focused on making good investments and managing risk and doing things that are value add, not sitting in Word and hitting copy, paste, and making sure that there's no typo edit.
And it's gotten painful because, now, and I totally get why, but, post FTX and with everything that's going on, there are, institutional investors that we have at Arca where I am getting a DDQ per fund on a monthly basis, updating holdings, counterparty exposure. So, and sometimes I have this information shared for investors to access on demand that I update on my own, but it's in a different format or it's using a different, technology or something. And it's just, but it's cumbersome. I get it. I get why people are asking for it. Standardizing it would be music to my ears. So
trying to find, these mutual pain points that we can actually solve without external influence, right? We don't need the whole industry to change. This is something within our control that, if we all agree gets us to a better place and gets investors better and more timely information, makes life easier on investment managers. Why not? We can solve this.
100%.
We can't solve everything. We can solve this. So continuing to find those points of mutual interest. Well, again, we're working on longer term solutions and longer term change as well.
Yeah, absolutely. Do you find that, depending on the manager that you're speaking to, I mean, Arca is obviously more of a, TradFi background, or, I've been called boomer and many, many other things that I can't say on this podcast. But, we adhere more towards that, traditional, diligence and processes and everything. So we would love to see things go more in the direction of, taking the best aspects and what's worked in traditional finance and improving upon others. But obviously there's, other market participants, let's just say, and some are our managers that, come from a more technology background where anything that resembles traditional finance is not welcomed. And it's like, this is not why I got in this industry. And if it comes here, I'm going to leave. Like, do you see a lot of that? Do you think some of that has exited over the past year? And where do you
I would say if they have that mindset, they are definitely not interested in AIMA membership. So they tend not to be fancy. But I do think they have. And, again, I think, both sides need to have a level of humility, right? I do think that the people who are newer to investment management, like I said, just need to understand and have respect for managing other people's money. And it is not the same, even if you've made, a small fortune in your own prop trading. There's reasons why we have customer and client asset protections. There's reasons why we have processes, these robust due diligence processes. And at the same time, I think the TradFi entrants need to have humility for, this industry that's built up, perhaps before their interest as well, and need to really spend time getting to understand the community aspect of it and not come in with a we know better perspective, because they can also get wrecked. Mm-hmm. So, it behooves all of us to, really come at this with a more open mindset.
Yeah, no, I completely agree. And I think humility is, one of the most important personality traits that anyone can have in any career. And it's also, at least what I've seen, one of the most rare, unfortunately. But so, one thing
for humility and humbling as well.
Well, I mean, many people have been humbled too in any market, right? I've been humbled many times, personally and professionally. My kids humble me every day.
I told my kids about the past, and they're like, "Oh, that sounds boring." I'm like, thanks, guys.
It's I could go on forever about that topic. So one thing, keeping on the topic of traditional investors and allocators, and obviously we've seen, as much as people like to say they don't, invest at the top and sell at the bottom, like people do, no matter who you are, right? And so have you seen? I know personally, I've seen entities doing their diligence who have not made investments, who either most likely delayed that process, right? Have you seen, and I've seen, a couple, but not many, and it's been more nuanced reasons why, who've actually entered the market and then exited the market. And maybe they got in for the wrong reasons, or maybe, the people who were working on blockchain left and they no longer have expertise there, and it's such a small portion of their overall assets that it just isn't worth it. Or maybe they no longer believe in the technology or use case of blockchain, which I think would be more rare and probably, frankly, just like disappointing. But what have you seen from your seat? Have you seen market participants exit the market? And if so, kind of for what rationale?
Yeah. So I think, if we look at the course of 2022, right, there was, 2021 into 2022, right up until May. I mean, in fact, we had a conference on May 11th, just as Luna was crashing. We had a lot of pension funds, endowments, foundations, really leading in, either making allocations or just about to. And that really put a pause on things. And, rightfully, understandably, right, okay, let's just digest this. What does this mean? What new questions do I need to be asking? Now, a few of them remarked, now we have data points for some of the managers that we've been following, and we can see sort of how this played out and, how it impacted their investment strategy. But you had seen sort of a flood shrink to a trickle at that point. It wasn't completely turned off, but, there was definitely a diminishment. And I felt, there's sort of a period in June where it felt like crypto was a bit of a communicable disease. Went to a few networking events and I'm like, oh, believe that.
Mm-hmm.
And that sort of softened as the year went on. And then, I remember I was at another event at the end of October and, it sort of felt then that, okay, well, everyone who's been using this point to reflect and delay getting ready to deploy some capital in January and, starting to feel comfortable again. Again, maybe not at the scale of early 2022, but, some reasonable mandates lined up and ready to, buy the dip and find an entry point. And then boom, FTX. And that, really just, it increased both the headline risk, right? Because, again, you have to think that these entities who are managing other people's money, it's not just about them. It's about their stakeholders, and they are typically accountable in the press to their boards. So that's a real issue, and it's not as easy a decision. So I think that really for the institutional LP, is just putting a hard pause on it for a while. How long it'll take, I don't know. I mean, definitely not. We're already in January. I'd anticipate at least 6 months. It is largely a momentum trade. So if something were to happen to turbocharge these markets and price action starts moving up again, you might see some momentum trading on it, but it's going to be a while to really regain that trust. And and even if you still have enthusiasts sitting at the firm, for them to regain the trust of their broader constituency. Now, what's interesting though is they haven't slammed the door. So I think there's still a receptivity to education. It's probably going to be harder to get them up on public forums and stages talking about what they're doing, but they might be in the audience. They know that this isn't, I think there's an expectation and an acceptance that this isn't going away. This isn't dead. We really need to see what comes out from a regulatory point of view, from an operational point of view, what other shoes are left to fall in this market.
Mm-hmm.
While that's happening, we can actually do our work and our background work without the, rush of FOMO that was driving everyone insane, during the last 2 years. So it's going to be hard. I mean, it would be much more frustrating if I were in my old seat of capital raising versus my current seat of doing the education. But, if firms have the patience and the working capital to weather these markets, I do think, keeping those dialogues open, being seen as an active partner in helping these folks continue to understand and, and see how the markets are developing will pay off. Now, the other investors that I think will continue to be interesting are the hedge funds themselves. So, in 2021 and 2022, AIMA joined the annual crypto hedge fund report that PwC and Elwood had been doing. Mm-hmm. So 2022 was the 4th edition of it. And our contribution was really looking at, okay, well, you all are surveying the crypto native hedge funds. Let us take the pulse of the non-specialists, the legacy. I mean, it sounds ironic calling them traditional hedge funds, so I try not to use that term, although sometimes I slip. But the legacy hedge funds, what is their pulse? Why are they investing? Why are they not? And we did see it was something like 20% were investing in 2021, maybe up to 38% in 2022. And, there is an inherent selection bias in any survey. But I did also notice around the same time in 2022, another media organization just pulled all of the ADVs of the hedge funds with over $1 billion and, checked their updated risk factors. And I think about a third of those had updated their risk factors to include crypto. So, it's that sort of third to, higher 30% is a pretty, reasonable estimate to see that convergence factor. And in many of these cases, it can be described as like a pinky toe position, right? Tiny, we're, fairly early stages. But again, it's, could evolve, for a multi-strat fund, like one of the many other things that they trade eventually. So that's something that's continuingly interesting to watch. I think, the continued lack of regulatory uncertainty will be a real impediment to that. And I talked to funds that had been preparing to integrate this into their live, existing commingled fund, and the results of the past year had seen them, okay, well, maybe we'll keep this prop trading or in the family office for a little while longer.
Right.
But there's still an interest, right? They may not want to invest today for investment reasons, and because of their investment thesis or outlook, it just may not be a good entry point based on whatever strategy they're running. But again, these are people who want to play with all of the tools in the toolkit, right? Eventually, they want this tool. They see it's a volatile asset class. It can have liquidity, can be long-term bets, and that's how some of them invest. It could be, more trading-oriented strategies, which will continue to bring liquidity and price discovery to the markets. So, again, it's important for them to continue to follow this, continue to understand what can be done within the confines of a regulated investment manager, and not how to understand the evolving regulatory landscape, the needs of institutional investors and their existing client base. So, for those reasons, AIMA is continuing to use the term, build in the bear markets, right? We have a lot of work on deck to support that constituency.
Yeah, I think that makes a lot of sense. I mean, I get the sense there's a feeling of inevitability to it, because no matter what has gone on in the past year, you still see the headlines from JP Morgan and Fidelity and Goldman and BNY Mellon and BNP Paribas, and their blockchain as a technology has a place in the business. And I think you're exactly right. You see something that's, gone up this much and fallen this much multiple times, and it doesn't die. And there are real use cases, and the people who enter the market and really enter the market, they don't leave because they see it, right?
Yeah.
And so there is inevitability to it. And I would think if I'm JP Morgan, right, and maybe a year ago you were thinking, okay, well, we got to go out and acquire the DCGs of the world or whoever, the Geminis of the world, to get kind of this client base, this business, this ecosystem. Now you can kind of build it in your own vision and really shape the market. And we both know how kind of lobbying works, and that can mean shape it in practical terms. It can mean shape it in education, congressional education, legislative terms. It can mean a lot of different things. And personally, I welcome that. I might be in a somewhat of a minority in the crypto world in terms of welcoming that, because I know there are mistakes that have been made. Look, industries make mistakes, and humans are driven by greed and speculation, and they always have been. And unfortunately, that's just the way a lot of people are wired. And and we see it we've seen it here too, right? SBF, I don't think, set out to run a fraudulent exchange, but when things compound against themselves and you have cultural creep and things like that, well, all of a sudden now you have a gigantic mess on your hands, and there's got to be things in place to prevent that from happening. And I would think there are a lot of opportunities there, but you're right, it's gonna take a long time, and I'm glad you didn't put a timeline on kind of institutional entrance back in the market, because there is no way to accurately
I'm optimistic. I mean, you bring up there's a couple of silver linings perhaps that will be useful before we bring this to a close. But I think, first of all, as you mentioned, I do think perhaps there will be acquisitions because of valuations, but talent-wise, in the heat of the bull market, anyone with an interest in crypto was jumping to a crypto firm, right? Because a lot, especially if they were at a firm where people were like, ugh, this again, okay, maybe you can, like, it wasn't being appreciated, it was being squashed, and they weren't being paid for it. Whereas they had someone who would, where they can monetize that expertise, great. So we saw a lot of migration of talent. These days we're seeing more layoffs than hires. So they're probably, going to stay embedded within their institutions for longer, which means there is that human capital that can organically develop these opportunities, which is long-term bullish for the convergence of, TradFi and digital assets. When we talked about the constituencies who remain involved and sort of the impact of the 2022 chaos on the institutionalization, if you look at the broader asset management and banking industry, it's not AIMA's natural constituency, but I have some friends there, and they have very long timelines, right? They're looking and building projects that are 2-3 years out. So it doesn't really change what they're doing, because they're moving so slowly, not in a pejorative way, but there's a lot of work that needs to get done. So they can sort of tune out the noise while they continue to build. And then, I've spoken mostly about the investment convergence, right? The hedge funds trading crypto, and making economic bets. But I think the other really interesting theme that'll be preeminent this year is, again, the tokenization of real world assets. And within, and that's really, again, back to that point of, we like this idea, we like sort of the shared ownership notion that blockchain can bring, that tokens allow for, but, we want the valuation driven by cash flow, right? Things that we can understand rather than hype. And when you look at sort of use cases within financial services specifically, there's a few ones that have been emerging. You've had this idea of capital formation on the blockchain, right? You've seen some closed-end funds in particular tokenize and look to raise capital. And, you can think about how that brings liquidity to the market, slightly more efficient secondary market. Not that someone's going to be listing a private equity token on OpenSea. It's all permissioned. Sure. It's KYC. There's a limit to how much can be traded, so they don't run afoul of various regulations. But it's an interesting concept. I mean, I think it'll be a while to do the education on the client side and the demand side, but it really dovetails with this theme of, I don't love this term, of the democratization of alternative investments writ large that we're seeing in the industry. And after a decade and a half of it all being about pension funds and institutions, seeing more capital inflows from independent RIAs, wealth advisory platforms, and so on and so forth. So this can solve that. It may not be the answer, but there's some interesting things happening in that space, responding to a real trend. And we're also seeing that in the lending market, and folks who are trying to securitize loans on the blockchain and see how they can bring real efficiencies, how they can bring real cost savings. In the last cycle, I remember it was, everyone was they would add blockchain to their name to seem trendy, and it was a complete marketing gimmick. So I think the real task is, what's being done for real functionality, where blockchain needs to be the solution, versus, again, just trying to capitalize on hype because what you did before is no longer working. So you need to pivot and find something. So I think that it'll be a culling process. It's a niche of a niche. So it's not the answer to everyone's problems, but I think there's some really interesting work being done in that, again, folks in our industry should pay close attention to.
That's great to hear. Really, really definitely is. And I'll close by saying, again, from a parallel standpoint, I think, if you look at what the internet did, it really democratized information for people, right? Everyone now can have access to information that they otherwise would have, potentially no chance of getting. And I think there's an element of blockchain. I don't want to say it's, democratization of capital or investment opportunity, because I think that narrows the focus to being a financial transaction. But there is an element where it's democratization of access and opportunity, right? And that could be anything from memberships to fractionalization of assets that would be totally out of reach for someone to own. In the past, like I personally, and I've used this example in the past, like I own a fraction of a piece of the fabric of the Wright brothers plane, the Kitty Hawk. Like, no chance I could have bought that myself, right? But I can own a fraction of it that, I guess you could have, done like the Rally Road and created an LLC, but then, that's just, it's kind of a pain, right? Now this makes it much easier and more efficient. So, look, Michelle, it was great chatting with you and getting your perspective, and I found it very encouraging, frankly, in this environment. And I would, hopefully we can, circle back up in a few months and retake the temperature on everything, and hopefully we continue to move forward in a measured and productive pace. So thank you for joining us.
And thank you for all that you do in the education and the productive dialogues that you're facilitating as well, because it's all part of the process.
I don't know how good I am at it, but I appreciate it. Thank you.
Okay.
All right. Well, take care.
You too.